It's 4 p.m. here in Singapore, DBS Asia Central. I'm Teng, Chief Economist at DBS Group Research, welcoming you to our January 24 Micro Insights live stream. I'm here with my colleagues, Senior Economist Radhika Rao and Economist Teng Chua. Happy New Year, guys.
Thank you so much.
Here we go with one more live stream. Very interesting times. A month ago at this time, we were busy doing our annual outlook presentation, and we were talking about whether there would be a soft landing or not. And since then, over the last 4 weeks, we've had markets go into euphoria about a soft landing ever since the Fed meeting and Chair Powell's rather dovish presentation. And then in the last week or so, a little pullback on that euphoria on the back of fairly strong data in the US. So initially, we thought we would call today's presentation the title Assessing Forecasts. In fact, that's what went out in the invitation that many of you got. But over the last few days, we thought maybe we should just take the issue head on, which is have the U.S. economic outlook now become characterized by one where there is no landing whatsoever, no recession, just some slowdown in growth. And around that, what kind of market dynamics can take place. And in addition to that, what can happen to Asian countries, which is where Radhika and Teng come up. I will first talk about the U.S. outlook and its implication with respect to Fed policy. Teng, you would then come in. You're going to cover ASEAN with a focus on Singapore. After with Radhika, you're going to cover India and Indonesia's outlook, election, budget, all sorts of stuff to talk about. And we've already received quite a few questions from you. Those of you who have sent questions have come to us through Pigeonhole by scanning the QR code that's on the screen. When you get a chance, if you have any questions or follow-ups from us, do reach out to us through that, and I will take stock of those questions then. Teng, Radhika, let me go over a few slides now, and I'll see you guys in 15 minutes. Sure. All right. Thank you. So here's the outline of today's presentation. As said earlier, I will start off by looking at the U.S. economic outlook and the rates implication. I will then add a couple of more quick slides on the commodity markets, which was a big source of inflationary outlook upside in 2022 and 2023, both on the upside and the downside. Question is, where do we go from here? And then I'll talk a little bit about regional trade. We're doing this presentation on the 11th of January. Over the last 10 days or so, we've gotten 3 important trade data points out of Asia, and we'll take stock of that because that gives us a sense of how the very end of 2023 panned out and what that means for trade-related momentum carrying over into 2024. And then, as promised, Teng would come in. We will talk about ASEAN outlook. He and Radhika Rao released an ASEAN 6 outlook earlier this week. They'll talk about that with a focus on Singapore. Radhika then will touch on Indonesia and India's macro and budget, as well as election-related discussions. All right, so here we go. U.S. economic outlook. First and foremost, the whole inflation discussion. The euphoria that I was alluding to earlier, that 2023 ended with the fixed income market in the U.S. rallying furiously. We went from high 4s to 4% at the 10-year yield. We saw markets beginning to price in 150 basis points in rate cuts in 2024, starting as early as March of this year. All of that was driven by the fact that the perception that inflation has more or less been conquered is setting in, as well as the messaging that was coming out of the Fed in the December meeting. But more importantly, the press conference that Chair Powell gave seemed to suggest to the market participants that the Fed was ready to sort of move on toward accommodating policy. Why was that the case? Well, first we'll look at inflation. We'll look at a few other things in the subsequent slides, but just look at the screen and the first chart that I have there. When we look at ISM manufacturing index, the price part of the ISM survey, if you see just how elevated expectations were in 21, which then paved the way for substantial inflation in late 21 and all the way through 22 and part of 23, that has all but gone away. The black line now is hovering around about 50, meaning 50% of the respondents to the ISM survey think that there is some input price pressure, but the others don't. Very good indicator of where inflation is going. If you see the lead-lag relationship between ISM and core inflation, they follow each other with a lag, but fairly tight following correlation. So if you were looking at ISM in 21, you should have been fairly worried about where inflation was going in late 21, 22. That's exactly what happened. And if you saw the ISM in late 22, early 23, you should have gotten a bit comfortable about the overall core PCE inflation outlook for the remainder of the year, and that's exactly what happened. Inflation has come down quite a bit. But as you can see also, that the ISM results have sort of gotten stuck around 50. Does that mean inflation doesn't have a lot more room to come down? Because whatever downtrend was predicted, well, that happened through the course of 22 and early 23. Not much has changed in the picture there. So its predictive capability with respect to where PCE goes may well have run out of its room. We'll think about that when we look at additional factors as well. When we think about U.S. inflation momentum, we measure that as a 3-month over 3-month, taking seasonally adjusted data, annualizing that. And that tells us that inflation, whether it is a headline level or core level, is running at around 3.5–4% range. Now, you may have noticed that analysts right now are focusing on a slightly different metric, which is a 6-month annualized rate of inflation, of which core inflation in particular is of interest because that shows 6-month annualized core inflation hovering around 2%, meaning if you are focusing on that metric, the Fed's objective has already been achieved. But I don't think Fed officials can start slicing and dicing various measures. 6-month annualized simply doesn't cut it. We have to see year-on-year rate of inflation, and there we are about almost still twice the rate than where we need to go before victory over inflation can be declared. So 2% on a year-on-year basis, on a 12-month basis, is still far away. Momentum is going in the right direction, but if you squint a little bit and look hard at the very end of the chart, it doesn't really give you too much room for comfort. Granted, core inflation rates have come down. But when we look at the last few data points, which basically are for the months of October and November 2023, there it shows that core inflation momentum is actually rebounded a tad, and core inflation momentum, as opposed to headline inflation, has sort of flatlined a bit. Very early days, maybe rent, maybe insurance services, things that have driven up inflation lately may disappear, and we will see further downside on the inflation side. But just by going as far as the ISM survey results as well as the momentum measures are concerned, you can breathe a sigh of relief about how bad inflation used to be and how much far they have come in terms of easing. But you are not yet capable, using these metrics, of saying inflation battle is over. I know this section is about the U.S., but I want to spend just a little bit of time talking about the region because the cue from the U.S. in many ways, through the supply chain, through the demand impulse, have impact on what's happening in the rest of the world. So when we look at Asian inflation momentum, CPI inflation momentum, food inflation momentum, core inflation momentum, they all seem very much under control. In fact, other than food inflation, nothing really was out of control in Asia. We may have had oil-driven inflation, a bit of an issue in 2022, but for most of 23, that also has not been an issue. So going forward, just like the U.S. inflation markers have cooled, I don't think, other than one or two major exceptions, India perhaps is one, we have too much to worry about as far as overall Asian inflation outlook is concerned. Now, we can say all that, but at the same time, you cannot be oblivious of what's happening around the world, particularly at the geopolitical end. When we look at shipping, for example, large sections of that go through the Suez Canal, Red Sea, Strait of Hormuz, and we all know that ever since the Gaza-Israel conflict broke out, there has been tension. Yemen's Houthi rebels have been launching missiles, attacking boats, and a large amount of shipment is now being diverted away from that area and going around Africa and coming to Asia. Anybody who has seen a map of the world knows that's a huge and expensive detour. We have the Suez Canal for a reason. And as soon as that issue has sort of percolated through market participants' expectation, we've seen a bit of a rebound in freight costs. So from a historical perspective, freight costs are where they used to be way back 5 years ago. I mean, not even marginally close to the kind of things that we saw during the pandemic years, but it is not going down any longer, and in fact, over the last couple of weeks, it has gone up a bit. So that kind of tells you that we can look at economic fundamentals, but we cannot be oblivious of the geopolitical factors as far as the drivers of inflation are concerned. The Fed may well credibly say things like this, even if they were to push up inflation, would be very transitory, should not be something that the Fed should be looking at, but at the same time, if headline inflation jumps a lot, it would be hard for the Fed to sound excessively dovish. As far as demand is concerned, coming back to the drivers of inflation, not just supply side, but also from the demand side, well, nothing to be sneezed at. U.S. growth, when I look at nowcasting measures, 2% and above, and I'll have a chart about that in a little while. But why is growth so good? Well, it's because lots of people have lots of jobs and have seen robust growth in nominal wages. And in 2024, that nominal wage growth will be complemented by proper, decent real wage growth. We haven't seen that in about a few years. And so while there's some degree of money illusion, and there's some degree of first-round expectation being impacted by decent nominal wage growth, but the fact of the matter is high inflation, particularly in 2022, but also in 23, ate up a lot of that wage gain in real terms. But in 24, for the first time in this cycle since the pandemic, we will see proper real wage growth, perhaps around 1% or so. My chart shows around 0.7. Assuming inflation turns out to be a little lower than our expectation, we are pretty conservative there, then we could get easily 1% real wage growth. Now, mind you, going forward, the wage story is not over. Just because there's some degree of cooling in the economy doesn't mean that unemployment is picking up or jobless reports are showing people getting a little more disappointed with the job market outcome. When we look at quit rates, when we look at wage bargaining in various parts of the U.S., including the writer strike and the union strike at the automotive area, they seem to suggest that labor still has quite a bit of bargaining power, and therefore we should expect, on the back of those industrial actions and settlements, more wage gains coming in 2024. The other thing to keep in mind on the wage side is that a bunch of states in the U.S. will be jacking up minimum wage substantially. States from Florida, which is a very red state, to California, which is a very blue state, you will see 5, 6, 10% increase in minimum wage. Now, whether that immediately translates into inflation or not is a whole different ballgame, but the point remains that if wage dynamic is very favorable, how can you rest easy as far as the inflation dynamic is concerned? What is the demand impulse there? So I said earlier that I was going to go through the U.S. nowcast. So we basically would probably end 2023 with the U.S. economy growing by about 2.3%. That is remarkable, considering the very sharp rise in real interest rates, all sorts of geopolitical uncertainties, and fear around domestic dysfunctionality. And still, consumers, investors continue to purchase, invest, spend, and as a result, we saw very strong growth out of the U.S., well above trend in 2023. For 2024, right now, at this very moment, the growth rate is still over 2% as far as nowcasting is concerned, but we think that it might be, the best as far as the year is concerned. We're looking at more like 1.5% growth for 2024, but we also had a fairly anemic expectation out of 2023 and got that wrong. So I would be a bit humble about our U.S. growth forecast for 24. When you look at consensus expectation, analysts are all over the place. Fact of the matter is, we just don't know where this thing is going. Such a big rate hike cycle ought to lead to slowdown in growth, and also the withdrawal of the COVID-related stimulus, depletion of savings. All of those things could play into growth slowing, but maybe not by a substantial amount. Maybe instead of 2.5, we go in the 1.5 range. I think the U.S. policymakers would be just fine with that. Maybe that would be one more ingredient toward justifying rate cuts if it's not coming from the inflation side. So, what should the Fed do? Now, one motivation for cutting rates is that if disinflation continues in the coming few months, real interest rates at the short end would keep on rising. As you can see in this chart, given our inflation projection and plugging in no change in Fed policy in Q1 and Q2, we get 2 more quarters of increase in real interest rates. If the Fed cuts rates by about 50 basis points over the next, say, 4 or 5 months, then they'll manage to keep real interest rate roughly unchanged. But mind you, this is not the most convincing argument, because as you can see, the path of real interest rates beyond that period is downward in any case. So all we're talking about is stopping the rate from rising just a little tad higher in the next 3 to 4 months, knowing full well that real interest rates would have come down anyway. So this would be a very dovish Fed's agenda, if it were indeed a very, very dovish Fed, which is, I don't want real interest rates to go up anymore. I will cut rates preemptively to keep real interest rates flat. Then real interest rates may well fall even further as I keep on cutting rates and inflation sort of flattens out. That's fine, but I want to get going. So that's the argument, if you will, for expedited, within a 3-month horizon, beginning of the rate cut cycle. But does it really make sense from a risk management perspective? Which part of the US economy right now is crying out for monetary easing? Are we seeing huge amount of personal and corporate bankruptcies? Are we seeing the property market meltdown? Are we seeing liquidity in money markets being affected by extremely high nominal and real interest rates? The answer is an absolute no. The resiliency and shock absorption capacity of the US economy over the last couple of years has been demonstrably remarkable. So if you are a super dovish central banker, what exactly are you trying to achieve by cutting rates sooner than later? And mind you, since Powell's press statement and the Fed meeting in mid-December, there has been a substantial rally in the fixed income market. So monetary conditions have eased substantially. The Fed de facto has cut already. So now do you really need to actually cut, given that the words of the Fed alone have achieved some degree of stimulus for the economy? What more does it need? And then final question is, of course, is the battle against inflation fully over? Are we sure that rents are going to come down? Are we sure that service sector prices, including insurance and financial services, would come down? Not too sure that one can be very confident about that, especially looking at what the auto insurance and home insurers are doing around the US with respect to their policy renewals. They're jacking up rates substantially. So I think that there is not a lot of slack in the US economy. There is still a desire to push up prices by corporates. There's still a confidence among consumers to go out and accommodate those higher prices and continue with their purchases. We haven't seen anything in the data so far that suggests that that dynamic is about to unravel. That, again, complicates the Fed's job of wanting to hike as quickly as possible. My personal view is that having had what is now deemed as a bit of a misstep in 21, when the Fed was convinced that inflation was transitory, this time they'd be a bit more careful, and the lingering resilience of the US economy, I think, buys them some luxury, some window where they don't have to cut immediately. They can wait till May or June. All right, that's about the US. We're not touching our forecast for now. Market may be pricing in rate cuts from March onward. We're going to see this week's inflation data. We're going to see forthcoming week's labor market data, and we'll make a call around that. For the time being, we still believe that we're about 4 to 5 months away from the first rate cut in this cycle, not 2 months. One of the things that we need to keep in mind is what's happening with commodities. I have a whole range of commodities on the screen, from crude oil, shown in the red line, to soybean and wheat, representing the food side of the spectrum, black and gray lines, and a couple of dotted lines or dashed lines on copper, proxy for industrial metal, and gold, of course, our favorite precious metal. And these things have all come down substantially through the course of 2023. If you look at this chart on a year-on-year basis, it's basically 0% growth as far as soybean and copper and crude oil is concerned. They're all basically the same level where they were a year ago. So they're not going to be on their own imparting much of an inflationary impulse. Gold is up a tad year on year. Copper is down quite a bit on a year-on-year basis. Bottom line is there's nothing in the commodity side right now that is alarming, but maybe it is as good as it gets, and there's not a lot of room for prices on the commodity side to go down any further. Oil, Saudi Arabia may be cutting capacity, but in the US, oil producers' margins are poor, strategic reserve is running thin, so there might be some supply side reasons and corporate profitability side compulsion for oil prices to go up, starting in the US and then elsewhere. On gold, typically, it's an inflation hedge. Why is it doing so well at a time when inflation is coming down? Maybe geopolitical factors, maybe something else. Central banks want to diversify their risks or something like that. But the fact of the matter is, among the commodity space, that's the only one that has shown some traction. With China's slowdown and global stocks being pretty ample, wheat, soybean, both of which were sources of massive concern a year and a half, 2 years ago, have all but dissipated. And then on the trade side, I've talked about the US rate cycle. Let's talk about this implication for the rest of the world. Asia, of course, stands to benefit tremendously, as do most emerging market economies, from a rate cut cycle, which would then be accompanied by a weakening of the US dollar. Also, if indeed lower interest rates hold demand together and the various cyclical dynamic we have seen on the electronic side, on the EV side, continue or persist along accommodating monetary and fiscal policy, then of course regional trade would do well. Americans and Europeans will buy more of our stuff. That's the bottom line. So let's look at where we are as far as regional trade is concerned. I have South Africa, Taiwan, and Vietnam on this chart because these are the three countries for which we have December data. So we now have all of 2023 snapshot here. So firstly, focus on the black line in any of those three charts. That's the Purchasing Managers PMI. And manufacturing sentiment seems to have completely bottomed out, whether it is in Taiwan or South Korea. Vietnam, it didn't really come down a lot, but it's hovering around high 40s. But then when we look at the red line, all of these three countries have seen exports weakness sort of being left behind them. Their exports are now turning positive on a year-on-year basis, and I think there's much more to come, especially given the sort of things we're seeing in the EV space, on the renewable space, as well as on the electronic side. So all in all, we're talking about a decent global economic picture here from our vantage point of January 2024. Yes, there are a lot of geopolitical headwinds out there from the Middle East to South China Sea, and there are also certain concerns one can have on the climate side. We probably got a bit lucky. El Nino was not that disruptive for global crop production last year, but who knows, something else might prop up. Just one earthquake or one flood here and there can cause havoc with global supply chain and supply of goods. So keep that in mind, be a bit wary of that. But short of that, overall inflation picture is not particularly worrisome. So with that in mind, I'm going to sort of end our discussion for the time being. I will take a couple of questions on the Fed side when my turn comes. But for the time being, let me pass the baton over to Teng. But right before you come, Teng, I just want to go over one more slide, which is the data points that we'll be looking at in the near term, starting with this week's inflation data. But I think we also need to look at what's happening in the U.S. with housing and rents, which is a very important contributor to inflation, and of course, labor market proxies like payroll. And as the Fed continues with quantitative tightening, at one point, do we see some wobbles as far as liquidity is concerned? Nothing so far. We do see banks very keen on holding as much reserves as possible, but so far, this historic rate hike cycle has not caused any major consternation in the banking system other than some regional bank issues a year ago. All right, with that, I'm going to stop. Thank you.
Thank you, Tamer. So if you have any questions, you can head over to the Pigeonhole link over here, and we'll answer them later on. So before I jump right into Singapore, let me just share with you some snippets in our ASEAN 6 2024 Outlook that myself and Radhika published earlier this week, where we term cautious optimism. So we highlight four aspects in this report. And firstly, with regards to growth, we expect a fragile recovery resulting from electronics recovery there. Inflation rise is going to be within targets. Fuel and food and commodities will be a key factor. And you heard from Tamer just now that commodities prices are pretty much well contained. Thirdly, we think that ASEAN central banks have no rush in front-running the Fed. And lastly, we touch on political dynamics in our report. So do take a look at our report when you have some time. So let me dive right into Singapore. And to just recap on our 2024 Outlook that we released about a month ago, we highlighted 7 key economic themes for 2024, where Singapore's economy will be one where it will be a year of renewal. So 7 key themes here. And since then, there are some data points that have came out. So let us go through them and assess the economic outlook since our publication of our annual outlook for Singapore. So firstly, on growth, Singapore is one of the economies that have released its GDP. So among their ASEAN economies, and from Singapore's advanced estimate on the left chart here in annual terms, you can see that Singapore's economy actually had a pretty challenging 2023. So growth came in at around 1.2% in 2023, which is the weakest since the pandemic. And even if you exclude the pandemic period, that's a touch lower than in 2019 was when growth was facing some challenges from the US-China trade tensions. But looking beyond the annual numbers and glancing into the quarterly trajectory, actually recovery is starting to emerge. If you can see from the right chart here, the year-on-year and Q-on-Q numbers have marked a turning point since the third quarter of last year and starting to tick higher after a very muted first half of 2023. And we can look into the various sectors to understand the dynamics here. And firstly, a very key sector that we have to look at is the manufacturing sector, which alone accounts for around 20% of GDP. And we are seeing signs of a turnaround after 4 straight quarters of contraction in year-on-year terms since the fourth quarter of 2022. And in fact, you see sequential momentum picking up quite reasonably as 2023 drew to a close. One important cluster to look at in the manufacturing sector is electronics. And here we are also seeing a turnaround. So Singapore electronics output is starting to benefit from the turnaround in global semiconductor sales. And in terms of expectations, Singapore electronics firms are starting to be a bit more optimistic over the next couple of months in 2024. However, I think the recovery is still quite uneven. When you look at electronics exports, they're still in year-on-year contraction. And granted, there's still some geopolitical tensions that could still maybe a risk to supply chains. But all in all, things are bottoming out, stabilizing, and are turning for the better. Singapore managed to avert recession even with the manufacturing doldrums due to the very diversified services sector and also construction strength. So just looking into the services sector, by and large, it has been quite resilient in 2023, the chart on the left. But we are seeing some trends shift within the services sector. So the trade-related services such as wholesale trade, transport has been underperformed in 2023, but should recover in 2024. You see that Infocom, finance, and professional services, also known as modern services, is turning around as financial services start to turn around gradually. Lastly, the accommodation and food and services that has outperformed quite a bit in 2023 due to the recovery in tourism, but the pace is starting to taper as 2023 came to an end. But in 2024, by and large, we think that the services sector would still hold up. If you look at the business expectations on a 6-month forward basis, it's still positive. And in fact, no sectors are in negative territory. 2 things to watch out for: the commerce sector, which includes wholesale trade, that has turned positive after being negative for a couple of quarters and in the couple of quarters of surveys. Accommodation is still quite positive, but the delta in terms of the tourism recovery will probably be more moderate in 2024, even if there's still some support from tourism. Just moving on to inflation, I think it's going to be quite a bumpy ride in 2024. So just recapping on what happened in 2023, I think inflation has basically been on the moderating trend in year-on-year terms, where your major categories, food, housing and utilities, transport, which together account for around 60% of the CPI basket, are trending lower, in year-on-year terms at least. But if you look at inflation momentum, in terms of the 3-month on 3-month basis, that is seeing some volatility and some signs that momentum is ticking up slightly. So on core, inflation momentum has ticked up slightly due to services being a bit sticky as wage continues to pass through. And headline inflation has also ticked up a bit due to volatile COE prices, and there could be some volatility there. Starting in 2024, there's some domestic price pressures that we are seeing. Firstly, from the GST hike, 1 percentage points to 9%. So you're seeing already some feed through, for example, in restaurant prices. In terms of carbon taxes, that's increasing, and electricity prices have adjusted up, as well as public transportation fares has also been increased since December. Water prices are also going to be increased in April. So these are all signs of domestic inflationary pressures. But Singapore imports quite a lot of its food and energy products, and basically global dynamics play a huge part as well. And here you see that import prices are still quite contained, also partly helped by Sing dollar strength. So on that part, over the course of 2024, we will probably see inflation ticked up in the start of the year, but eventually moderate. So Singapore is going to have quite a packed schedule to the start of the year. So 2 upcoming events to watch for. One is the MAS policy review, no later than Jan 29. And in February, we'll see Deputy Prime Minister and Finance Minister Lawrence Wong announce the budget 2024 on February 16. So let me just touch on the MAS. Basically, they are returning to quarterly meetings from their and they have been doing biannual last year. And for the January meeting, we are expecting them to keep things on status quo, being vigilant on inflation. And just to recap, our FX strategies has its model. And over the course of October 2021 to October 2022, we have seen MAS tighten and recentered the band by our estimates up by 4%, and the slope has increased up to 2.5%. So quite tight policy, and that's helped to dampen some of the inflationary pressures. But with some of the upside risks, perhaps from the Red Sea developments as well as domestic price pressures, the MAS is going to be a bit more vigilant at the start of the year. But as the year progresses, we think there's room for less steep slope in the second half of the year, in line with some of the rate cuts that could happen in global central banks, more of a normalization more than anything. Next, in terms of fiscal policy, we think there's going to be prioritization between short-term and long-term priorities. When we look at the government's fiscal position, actually in the government's first 3 years of its 5-year terms, it has managed to accumulate surplus, somewhat quite similar to the average balance over the past 10 years, even considering that we had to tackle a COVID pandemic. But the recovery there allowed for the government to have a surplus, and therefore there's some room to perhaps provide a sort of slightly expansionary fiscal policy in the upcoming budget. So cost of living is still an issue in the short term, and longer term wise, there's going to be, prioritization of some of the ideas that's being put forth in the Forward Singapore report. providing assurances in whether regarding job disruptions or things like retirement adequacy. So in conclusion, I think looking at the data that has come in, we continue to hold our view that growth is going to recover in 2024 to around 2.2%, but a fragile recovery nevertheless. Inflation is going to be bumpy, and do watch out for the two events that are going to come up. So let me now pass my time on to Radhika, which will bring you through the rest of her presentation.
Thank you so much. Thank you so much, Teng. Good evening, everyone. So let me pan your attention, focus now from Singapore. ASEAN as a whole, some of the countries are quite exports focused. I think I'll borrow some strains from what Taimur mentioned. He does touch upon commodity prices. And I think that would be the emphasis I'll start with for Indonesia in particular, and also pull some strains from that to India. Now, starting off with the, what does commodity mean for Indonesia? Obviously, Indonesia is a resource-rich country. It has been over time, at least in the past decade or so, and much more in the last 4-5 years, trying to move away from being only an exporter of raw materials to an exporter of much more value-added commodities. Nonetheless, I think the boom and bust that you saw in the commodity prices in the past 2-3 years has come back to take an economic bite. I've just taken some key commodities here, and I've indexed that to 2019, and just to show you the scale of increase and thereafter correction that you have seen in commodity prices. I think what stands out in particular is, of course, nickel. You've also seen palm oil and coal in particular quite important for Indonesia. But on an incremental basis, certainly nickel prices and nickel as a commodity for the downstreaming activities has gained a lot of traction. So what's interesting here to note is, of course, commodity prices have come down. They've still not gone back to 2019 levels, but they've nonetheless corrected. But you would immediately, expect fall in the exports, Indonesia's exports in particular. It has moderated, but what you have seen is in certain commodities, a very good example in this realm is coal. In fact, even though value has come down, volume of coal exports have continued to be high. In fact, in the first 10 months of 2023, you've seen China as well as India actually buy a lot more from Indonesia, and helping to hold up volumes, though prices have come down. So in China, for example, we all know growth has slowed down, but nonetheless, you've seen higher production because of climate change, hydropower, electricity generation has come down. So coal-fired plants have had to step up, and so those kind of one-off factors have certainly helped to hold up volumes. But nonetheless, I think overall prices correcting has shown in the commodity exports, and in the chart on the left as well as the right, in different aspects, you've seen exports come down. You've also seen that impact on the overall trade balance for Indonesia. It was at a record high in 2022, also in early part of 23, and thereafter has continued to moderate. Now, what are the implications for these? These essentially have implications across the board. You would see that the current account balance, which essentially draws strength from the goods trade, has also moderated. But nonetheless, imports haven't picked up so much. So net, the current account hasn't been completely out of whack. So you've still seen the current account on the year. We think it will be about 0.5% of GDP. So pretty narrow as compared to the past. And usually the scale of comparison used is during the 2013 taper tantrum. So we're certainly nowhere close to that in terms of macro imbalances. While commodities and exports matter a lot to the economy, I think when we look at the year ahead, and I think that's a theme that's coming on from 22, 23, as well as going into the next couple of years, is going to be about moving away from just doing raw material exports to moving up the value chain. And here you will hear a lot of conversation on how the nickel reserves that Indonesia has helped it not only increase, say, stainless steel production, but also delve deeper into EV batteries, attract a lot of investments. In fact, FDI has been at a record high for almost 2 consecutive years, continues to be high on a quarterly basis as well. So that moving up the value chain has provided some amount of resiliency to not only trade, but also on the investment front. For the year, then, these are some of the themes. We'll urge you to please go ahead and read our regional outlook as well as the country-specific outlook that we published in December. We delve on each of this in great detail, as well as the report that Teng pointed out to, which was an ASEAN 6, which was published earlier this week. So here and now, what matters for Indonesia, I think the first quarter is all about the elections. In a month's time, we're going to see Indonesia head into the presidential elections. The incumbent president, he's basically completed his 2 terms. So you're going to see a new president who's going to take office. The opinion polls have one of the pairs, which is basically the current defense minister and his vice presidential candidate, both of them in the lead. I think the predominant question to ask for is what do they stand for, and will they be able to garner enough support to not have a runoff in the June. So basically, February doesn't come out with a clear mandate. You will have to have a June 2nd runoff. So what do they stand for? They essentially stand for more of the same. They are really candidates of continuity. You've seen growth, inclusion in terms of also downstreaming activities. They're going to continue all of those policies. And at this point, the opinion polls suggest that they are in the lead with about 46% of the overall poll. So if that comes to pass, that means they will just miss the 50% mark, and you're going to have a runoff in June. Apart from that, Indonesia, of course, will be watching out for the China and US growth outlook. For US, we expect a soft landing. China will be more important because China is a key trading partner for Indonesia, including the commodities space. For inflation, weather will matter. And by weather, I mean rice. Rice from quite a few of the Southeast Asian countries has quite a heavy weight. So which way rice prices go will impact inflation. But nonetheless, many of the governments have stepped up imports. They have put up social support measures to try and put a lid on higher food filtering through inflation. And particularly in an election year, that certainly gathers a lot more attention. Now, putting all this into view, what does that mean for the central bank? They're going to see an inflation which is going to be within target. It's an election year. Growth, we think, will be about 5%. But they will be looking at what the Fed does. If the Fed action is according to what we expect, which is that they would not be in a hurry to cut rates as yet, we don't expect Indonesia to also front-run the Fed, for financial stability's sake. So they will keep an eye on Fed's commentary. They will keep an eye on what Fed does. And according to our own baseline, that they will move only in the second half of the year. So that wraps up very much Indonesia. Let me then go to India. And here too, I draw upon the commodity story because one of the commodities that matter to India in particular are oil prices. While we've spoken about coal and nickel and that group, with oil, it's been an interesting ride. It did see a brief run up, but since the Middle East tensions, even though they've been simmering, you haven't really seen a huge impact on the oil prices. So in some ways, markets are looking at crosswinds. On one end, OPEC Plus has cut production. On the other hand, you've got growth slowdown concerns. So I think the markets will only be convinced of pushing oil prices higher if there's actually a physical disruption to the market, not worries of physical disruption. So as on date, it's somewhere around the $75 mark. So certainly not highs. Benefits countries like India, which are one of the they depend on about 80-85% of India's demand oil requirement is imported. So it certainly helps the external balance. And apart from that, India also did buy Russian oil, which was earlier available at discount, and that discount has narrowed since. But nonetheless, lower or rather manageable Brent oil prices mean that the net oil trade balance will remain favorable. But while trade does what it does and benefits from lower oil prices percolate, I think for the economy, what will matter more is what's happening in the rest of the engines. This is essentially for growth. What you see is that domestic components will be of more importance, particularly what's happening with the investment cycle, and that too in the households as well as the government investment cycle. Government public spending has increased in terms of putting more money in infrastructure, particularly roads and transport, railways, and so on. And at the same time, we've also seen real estate construction pick up as well. Consumption has been a two-speed engine. You've seen urban demand pick up. Rural is off lows, but nonetheless, it faces weather as a risk and inflation as a risk as well. So nonetheless, I think India has found its domestic growth story to be quite strong, and that's certainly helping the economy maintain very strong growth rates of about 7%. So the government recently came out with its advanced GDP estimate for the year ending March 24, and they've pegged it at about 7.3%. So very strong compared to G20 countries, very strong compared to regional peers as well. So that's dominating the story, and I think this will not only be here and now, but will also spill over into the year we're going to go into April onwards. What are the points that we are looking at for India? I think the immediate event is going to be the budget. Now, we should remember this is an election year also for India. April, May are going to be the general elections. Now, in that kind of a year, the budget that is just announced prior to the election, you tend to see a vote in account. Basically, it's an interim budget, more to do with how much money needs to be set aside till the new government comes in, and thereafter they present an actual budget. Nonetheless, this budget will still get a lot of focus because you would like to see where the incumbent government's priorities are. We think there's going to be measures for cyclical as well as structural drivers. Cyclical to do with rural farm sector, and structural to do with higher capex. That's the kind of bifurcation, or that's the kind of components we think that the budgets will carry. Nonetheless, we don't expect a blowout in the fiscal deficits. India has been able to bring down its fiscal deficit, in the past 3-4 years from gradually pulling back on the pandemic-related spending. So we think that there's going to be another 40 to 50 basis point of correction in the fiscal deficit that's going to be tabled in early February. I think, and overall revenues generally, as you can see in the chart here, have been doing very well, direct as well as the indirect tax collection. So that's kind of also provides additional support to the budget math. So following the budget, elections will come into view, which is in April, May. So first half of the year, you can expect much more narrative to be around this. On a structural basis, of course, you've seen a lot more conversation on manufacturing becoming a big part, soaking in employment, more companies looking at India as a supply chain diversification location as well. And not only electronics, you've seen some more moves in, say, for semiconductors, and some of the bigger companies also looking to diversify from China, looking especially the Western as well as the North Asian countries. I think with this, I'll conclude. And if you have any additional questions, request you to please put it into this pigeonhole. At the same time, we will pick up the questions that have already been placed here.
I think we have enough questions.
We do. Okay.
I think so. I think those who have not asked the questions yet, I'm sorry, I think you have missed the boat. Let's start with you guys, because there are quite a few on India and ASEAN, and this one specifically addresses you, Radhika. Let's see, put it on the screen. It says, hello Radhika, Nifty seems to bump every time you expect a correction. Do you feel Indian market in a euphoria zone, and what are you expecting from the budget? I think the budget part you've already covered. Let's talk about the Nifty part.
Certainly, the equity markets have, I think, even despite the valuations worry, despite the exogenous headwinds, have continued to surprise even the most optimistic people. I think it is driven by a couple of factors. I think number one, of course, the corporates have done well. Margins were wide, so that has helped earnings in general. And going into the past few months, you've seen actually commodity prices come down, so input costs have come down, and that's helped the top line as well. At the same time, you've seen a bit of a change in the mix of what drives equity action, particularly investors, and you've seen retail investors become a much bigger part of
domestic retail,
domestic
yes.
investors. Yeah. So even though foreigners have been in and out, but foreigners on a whole have been positive as well, but retail investors are certainly becoming a big part of the equation. So I would I mean, though we are not equity analysts, I would think that given the broader strong growth picture, the government being extremely pro-business, pro-investment, that you could see further gains during the course of this year. And of course, what happens with the exogenous factors, particularly the Fed, if they begin to cut rates, that's again another bump up for the emerging market equities.
So Radhika, this is not necessarily related to the equity market, but financial markets sometimes do get ahead of themselves, especially if there is a huge leverage-driven rally. We have seen some indicators in India that at the consumer level, leverages have started picking up. Are you concerned about this issue?
Oh, that's an important question, and something that has even caught the eye of the regulators. They had been mentioning about unsecured consumer loans in particular, and if you see the latest RBI's financial stability report, they have given out some indication that one of the reasons why they were concerned. But they've taken proactive action. In fact, just a couple of months back, they have come out with, for the banks as well as the non-banks, they've tightened risk weights for consumer loans to make sure that that doesn't become a problem down the line. So I think that kind of proactive action certainly helps. And I think that's where we think that there won't be any macro spillover from these kind of concerns.
Very good, thank you. Okay, Hunting, your turn. I'm going to put this on the screen now. What will be the impact on Singapore macro as GST is raised by 1% this year?
So I think there are two aspects of it. The first aspect of it, which is near term and price related, I think we covered quite extensively in our presentation, where GST hike would have upside domestic impact on prices, so a temporary bump up in inflation in the near term. But we also need to consider the long-term impact about GST. So GST is one of the top 3 revenues within the operating revenue bucket, and therefore the 1% hike in the GST, and this one is the second phase of it. So in 2023, we also saw one percentage point hike. So this would basically provide the government with fiscal revenues and buffers to tackle some of the long-term challenges that they may face, whether it's healthcare related expenditure or whether more unexpected or incoming stuff, shocks that might take place, or even really, really long-term stuff like climate change, whether it's building out the Long Island plan that they are thinking about. I think this increase in revenues will help in those aspects.
Okay, but what about the cost of living issue that is already been a source of stress for Singaporeans? Would a GST increase in anticipation already has had an impact on inflation, or would that be something we'd have to worry about feeding into various retail goods?
So, I tend to walk around to see the impact on some of these. For example, the GST hike. When you go to restaurants, you automatically see in your receipt increase in 1% GST hike. So that's already having an impact on some prices. But for example, if you go to the supermarket, some of the supermarkets are absorbing some of the GST hike. So in that sense, when some of the essential goods, if you go to the supermarket, that would be more contained. So it depends on which aspects you're really talking about. And also, I think considering that there will some upside price impact from GST, the government also understands that the lower and middle income might also be affected by, not just the GST, but hikes in public transportation fares. And therefore, I think whether it's in the budget 2023 or in September last year, the cost of living package support that's been put in, those are efforts to try to mitigate some of the impact to vulnerable groups.
Yes, I think that sort of targeted approach does make sense. I don't think the cost of living issue is going away anytime soon, even if the rate of inflation comes down. I think the level shift over the last pandemic years and subsequent sort of pickup in demand around the world, I think is going to be something that we'll be living with for a while. All right, thank you, Hanteng. Back to you, Radhika. What is your outlook for India policy rates?
Yeah, certainly, I think for not only India but Asia in general, that's one of the questions being posed. Where to from here after say 1.5 years of consecutive hikes? For India, I think what the central bank has done is they've been proactively quite hawkish. I think at least the past 3-4 policy reviews, the central bank governor has been explicitly mentioning that inflation might be down sometimes on base effects. But nonetheless, they're not letting their guard down. And I think one of the factors is food. Food is got a 40-45% weight in the basket. Because of weather vagaries, you sometimes see food, particularly vegetables, which is like a staple, swing quite dramatically. So sometimes you see inflation, that picking up inflation all the way to 7%, and otherwise, when base effects kick in, it goes down to sub 5%. But I think they've been on the right side of the call, which is that they've been much more guarded. From here, what do we expect? We expect them first to signal a change in their stance. So stance right now is withdrawal accommodation. We think they will shift to a neutral somewhere in the second quarter of this year. And in the second half of the calendar year of 2024, we think they will start softening their stance. But in the meanwhile, I think what they're doing is that liquidity-wise as well, they've tightened liquidity to make sure all the policy signals are in sync. They're also taking macroprudential measures, like we previously discussed about risk weights. So they're keeping an eye on any potential bubbles because growth is certainly very strong. But I think they're not going to be in a hurry to cut rates. There are some quarters in the market who expect a rate cut as early as the first half. We are in the camp looking for a move in the second half of the calendar year, but preceded by a change in their stance.
Right. Again, from a risk management perspective, what's the downside of not cutting rates immediately? It's not like there are parts of Indian economy that is at risk of slowing down sharply, that a rate cut is urgently needed. It's not like liquidity is so tight that there is no credit creation. In fact, the authorities are doing macroprudential measures to do the opposite. So I think there's actually an analog between your look at RBI and my look at Fed, which is that you could argue that the worst of inflation is behind. You could argue that maybe interest rates have room to go down, but at the same time, there is no urgency given how robust the macroeconomic outlook is.
Absolutely.
By all means. All right, so there are lots of really good questions. We don't have the time to go over all of them. Let me just take the most voted one, and I apologize to others who have sent very interesting questions, especially there was one on AI. We'll have to do another webinar to discuss that one. Is China experiencing deflation? Very small question, requires an extremely elaborate and long answer, but I have about 2 minutes. So the short answer is not widespread. There are certainly, been substantial asset price deflation, housing and equities in China over the last few years. No question about that. And there is a debt deflation risk embedded in the economy, given the huge amount of debt. Potentially some of it is non-performing. Some of it will probably lead to significant haircut, if not outright wipeout of capital of investors. So those things create an overall deflationary risk, no question. When we look at PPI inflation, when we look at CPI, clearly, again, there is not that much robustness of demand, which is why there's very little price impulse right now. But compared to major deflationary episodes, take Japan, for example, in the 90s and also the 2000s, China is quite different. It still has robust economic growth rate, relatively speaking, compared to what Japan had. The peak to trough adjustment in asset prices that we saw in Japan, China is much smaller. The kind of dysfunction we saw in Japanese banking system during the bubble burst of the equities in the late 80s, simply not there in China. The authorities have a far stronger command and control system in place. More importantly, a country like Japan that inherited a very strong exchange rate because of the Plaza Accord, which then caused, again, an additional lever of fighting inflation simply disappearing. China doesn't have that. If you, in fact, look at the RMB, it has actually weakened in the past year or so. So I think there are lots of arguments to be made in favor of not giving up on modest inflation in China. I think that is still our base case. Not high inflation. It would be nice if there is more optimism and dynamism in China, the way, for example, we see spiking in India, where then inflation becomes a bit of a headache as opposed to deflation become a worry. So clearly, on a balance of risk perspective, deflation is a concern, but I don't think there is widespread deflation being faced by China. Some decline in property prices and equity prices notwithstanding. I wish I would have taken more time to answer this question because this is a deep question that requires a deep answer. Our wonderful China team led by Moji in Hong Kong, they will be working on this and presenting their findings in coming months and quarters, so watch out for that. So with that, we're going to end our January 2024 Macro Insights live stream. Radhika, Teng, thank you very much for your inputs and support.
Thank you very much.
And we will see you next month. Take care, everybody. Stay safe, stay healthy.